Welcome to PhillipCapital's Weekly Market Watch. Uncertainty grips the Singapore market when the bulls and bears cannot agree which direction it wants to take. Retail investors are also mixed and waiting on the sidelines amidst negative news from Europe and the growing concerns regarding the US recovery. Today, we will find out from Ms. Cheryl Chen, CFD dealer from Phillip Securities, if there are still opportunities in the Singapore market so as to take advantage of the current market conditions. So Cheryl, the Straits Times Index has been experiencing low but steady appreciation in the last 2 months. In such a sideways market, what are your views on trading the Singapore market?
In June this year, the market volume thinned and quietened down partially due to the quadrennial World Cup. So naturally, many local investors toned down their investment activities to stay up through the night to watch football matches. This is evident from the drop in volume traded on the Singapore Exchange of about more than 20%. After the World Cup ended, the volume did not return immediately, as there were still world economic concerns that plagued the minds of our investors, such as the European bank stress test and the less than lackluster US recovery. This volume may gradually return because we are in the view that the outlook for US markets is positive in the long run and would affect the Singapore market. However, in the meantime, investors should be positioned to protect themselves against downside risks. You see, some of the US economic data being released seems to boast of more contractions, such as total non-farm payrolls and employment levels, which explain the sell-offs to price in the economic uncertainty.
Given this backdrop of an uncertain market, what are your views on the trading strategies retail investors can undertake?
Now, as the market shows uncertainty on the direction to take, retail investors can look out for stocks that are bottoming out. While the Straits Times Index's daily movements have not been spectacular of late, there are companies that have been shown to be oversold and can be considered for a long portfolio. One example would be like the S chips, which seem to be consolidating for a breakout. So you can look out for significant levels of resistances and supports. In any case, as a growth story, China has been consistently in the limelight. What with news on appreciation of the yuan, regulations to rein in the property market, and possibility of relaxing its policy tightening measures, you will notice that comparatively, S chips typically trade at a lower price to earning ratio compared to their counterparts and competitors trading on the China exchanges. We would recommend that investors choose their stocks wisely, whether it is for a short-term trade or a long-term investment. As you know, for these S chips, there have been previous cases of scandals and poor profit levels, so they should do their due diligence well. Looking at the fundamentals of these counters should remain an important part of their strategy. Whichever strategy retail investors decide to take up, they must always ensure that they practice prudent risk management, such as a good trading platform that allows setting stop losses.
Recently, the Housing and Development Board announced the building of 7,000 new flats in the second half of 2010. What are your views on how this might affect the property sector?
This is in addition to the 9,000 new flats launched in the first half of this year, and there are also plans to add another 4,700 new flats under HDB's Design, Build and Sell scheme. The rising property prices would probably be cooled temporarily. One of the reasons is it takes time for the building of these flats to be fully complete. Secondly, these new flats are mainly targeting first-time buyers, so those participating in the resale market will still have to compete on price. Thirdly, one of the contributing factors to ever-rising property valuation and cash overvaluation, or what they call COV, that potential home buyers need to pay over and above the valuation price can be attributed to the increasing number of foreigners. It is hard to imagine that the number of limited residential homes can match the demands of this growing foreign talent. This addition to inventory of new flats can only support a portion of the demand. In the meantime, private developers are also adding to the action, with high bids going for scarce land, which would naturally lock in the per square feet price at a higher range when the development is ready for launch. In June, the property market did cool due to a mix of factors, including potential home buyers' view that the property market is slightly toppish, which also affects mortgage loans that banks are willing to offer at these prices. This correctional phase may continue in these few months, which may be reflected in the share prices of property companies.
Thank you, Cheryl. That's all we have for you today. Tune in next week for more market updates.